Good morning, everybody. Welcome to our August webinar. Can you believe it's August?
I know. Good morning, Jeff Buckley.
I'm Dan Kautz, and I guess I was so excited to say it's August. I look back on these, Jeff, and it seems like I'm always excited about the month. Like, holy cow, it's already here. And there I go again. It's August already.
Yes, yeah.
But, man, time is marching.
It is.
And
That's right.
we just got to grab every day and make the best of it, right?
Wow, you're very positive
Yeah,
today.
today I am.
That's good.
Well, we
That's
saw some good economic indicators, so
Yes.
we'll see how this all pans out, right? But let me do my housekeeping here. This is our webinar for August. It'll be posted on our website. We did do a little changing on our website, so you can go to helpful resources and find the webinars right in there. And we're really doing a nice job on getting those up a little quicker, and also getting the the newsletter put up there too.
Yep.
So you can check these out on the web page. Also pass them on to a friend if you wish. We can't take any live calls or texts at this time while we're recording these. And of course, our contact information is dkautz@kautzbuckley.com and Jeff Buckley or J Buckley at kautzbuckley.com. Our phone number is 716-276-8480, and the ever popular text number is 716-272-1129. Now that we got that out of the way, let's go to the format that you always set out for us here.
Yes.
So let's take a look at where we are with the markets here, Jeff.
Yeah, so this is, again, as we usually start with the look in the rearview mirror. So this looks back on the month of July. And July was a good month. July was a good month for the financial markets. It was a good month for just about every type of equity or stock out there, which is a positive. We got some breadth to the market. Bonds kind of held where they were, so you were still getting some good yields on the bonds that you may own in your portfolios too. So you can see it was, the growth still tended to dominate. Growth being a lot of the high tech companies, that really their earnings are growing exponentially at this point. So those were the NASDAQ composite is where most of those types of stocks are housed. And then we've also got the Russell 1000 growth. So that's focused on really kind of the top 1,000 growth-oriented companies in our economy. And those led the way. NASDAQ 100 just trailing, but even the S&P 500. Now you start to get in a little more breadth in the market. So you're looking at stocks of companies that are in different sectors, even utilities, that kind of thing. So we really had a pretty decent month, and as a result, we've now kind of recovered from the shock. We started the year out pretty well. We had the shock of the tariff announcements, in April, right at the beginning of April. Markets really dropped significantly. I don't know that we have a lot more clarity on the tariffs, but we're starting to at least get frameworks of deals in place. Most of these frameworks, at least that we have so far, seem to be positives to the U.S. economy. There's some additional foreign investment coming in, or at least some promises being made. Right. I guess we'll wait and see if they all hash out. But so things are looking pretty good. And so you can see even for 2025, we're doing okay. The markets have had a pretty decent year so far, recovery from that April drop, and we're getting almost all the way back. And look at 2024 too. Now, when we stack 2025 on top of 2024, we've really had a good run in the financial markets with really not a lot of setbacks. I mean, really, it's just that the tariff announcement.
The tariff announcement was a pretty good hit, but we have recovered, like you said.
Yeah.
And if you notice, a lot of negatives have erased. Although the 52-week high, can you just address that column?
Well, yeah. This basically just means if you go back to, in this case, August or July, I'm sorry, of 2024. And look for that entire past year, we really we're very close to the highs, but we still haven't made it back yet. So a lot of that is kind of the moves after the drop that we saw after the tariff announcements. Notably in this column is small companies. Yep. Yeah, small and even mid-size. We get to the mid-size, the S&P mid-cap 400. There's still a lot of thought amongst investment professionals that this is an area of our economy that's currently being undervalued, and a lot of people are recommending at this point reallocating portfolios. Yeah,
we did that a while ago. We were looking at bringing more of the mid and small caps into our portfolio, which we have done.
Yeah.
And again, it's everything you just said. It's a little undervalued, and it might be an opportunity where we can find some growth in there.
Right.
Let's just be careful you don't want to be overweighted there. You
Yes.
just want to add a little bit to that
Yes.
recipe. It's like a little too much salt sometimes in the sauce, just a little.
Well, and I think too that the where we are currently, 6 months ago there were talks of rate cuts coming from the feds, and that helps smaller businesses because a lot of these smaller businesses rely on financing to keep their operations going, and when those interest rates are staying high, it's more difficult. Yeah, it cuts into their overall earnings. We're that much closer now to where we think rate cuts are going to be coming. They haven't hit yet, but we think they are coming. So we could definitely start to see a rotation in the market.
And then that's why we're saying it's undervalued.
Right,
Something
right.
like that happens, we could see a little growth in that sector. Not only that, it would also help our bond holdings too.
Yes,
So,
that's correct.
good. Moving on.
Yep, move on.
All
And then
right.
I just touch on the sectors here too. This is just a little bit of a drill down kind of on that prior slide. It really just kind of shows technology is really still leading the pack. I mean, it really has done a great job over the past year and a half. However, you're starting to note, like in 2025, industrials. A lot of this is I believe. I mean, we're waiting to see it reflected in a lot of earnings, but there's a lot of anticipation that the reshoring of industrial manufacturing in this company or this country is going to continue to accelerate the industrials. So that's an interesting move in our overall economy, how that's shaping up. Communications remain strong, and financials, that's another area that comes from the thought that the government is really moving towards deregulation, especially in the financial area, and that could open up the door for mergers and acquisitions, that kind of thing too. So if we do see continued announcements out of the government of deregulation, that could certainly help the financial. The financial.
Kind of surprised me on healthcare though. Bringing up the rear, not terribly.
Yeah.
But we have such an aging population. You would think that healthcare has a little more.
Well, that's an area, people have been watching a lot. I think there's concern there of Medicaid and Medicare cuts that could have an impact on
how
that
it's reimbursing
too.
hospitals
Yes.
and nursing homes and
Right.
stuff like that. So to be announced.
And healthcare too, it's still a good area to invest in because I know a number of my clients of our clients really have investments in that area. And even when the stock is not necessarily overperforming, you're still earning dividends on a lot of those companies. So that's very positive.
Good dividend play.
Yeah.
So all right, moving into how the markets look. This is going into the Morningstar reports that we take a look at a allocated portfolio.
Yeah, that's right. And again, we like to point out that the first couple slides there, we were looking back, and that is very focused just on the equity or the stock markets. This is really much more reflective of how your portfolio is going to be set up because we don't have any clients that are 100% in stocks. We don't have any clients that are 100% in bonds either, though. We've got a nice allocation there, depending on what your time horizon is, what your goals are, that kind of thing. So this just kind of gives you a quick snapshot of where we are right now, and then some past performance of different types of portfolios. With again, the most aggressive is going to be your 80% equities, 20% fixed income, kind of moving down to someone that's much more conservative, only about 20% equities or stocks, and then the remaining 80% in fixed income. So you can see there's not been a huge different year to date. And the reason is because bonds have been holding up pretty well. And we've also had, we had that pullback in April on the stocks. And although they're recovering, that did cut into some performance there. So if you have a well-allocated portfolio, which I know all of our clients do, you've been doing okay, really. I mean, keeping up. Go ahead.
Yeah, well, keeping up with the Joneses, with the market.
Right, right.
But it's interesting that, you got with a 20/80, an 80% equity, 20% fixed income, and 10% rate of return to something that's the other side of the coin is 7. That just shows you're not getting that much less of a return, but you're taking significant less risk, which goes to what you were saying about the bonds holding up. And with interest rate cuts seem to be on the doorstep. Seem to be. Remember about the seesaw. Interest rates go down, the value of a bond goes up. So if we do get a 1/4 point cut, bond portfolios are going to perform well.
Right.
And they're gonna the value of the bond will go up. The interest rate that the bond pays, the coupon, will remain the same as the contract of that bond.
Yeah.
But this is we could have a little bit of strength coming into the next few months.
Yeah, no, I think so. And even if you go back a full 12 months too, now you're looking at the outperformance of equities has really
now
shows.
you see the difference
Yeah.
between the 18 and 25, where here you only have a 3-point.
Right.
Yep.
But in other words, we've strung together a couple positive years here overall. Regardless of how your portfolio is allocated, we've been able to get decent returns on both the fixed income and the equity side. So even the 3-year returns, if you're heavily weighted into fixed income, you're still staying ahead of inflation, which is important. But the returns aren't quite as high, obviously, as they are with some allocation to equities. But you've got it. You're doing okay at this point. So.
And it wasn't too long ago. We had slides up here that showed a lot of negatives in the 3-year column, and that was earlier. That was not too many months ago.
Right.
And all negatives are gone except one in that bottom right corner.
Yes.
And that's only a small little amount. So overall, market's doing well.
Yes, it is. That's true. So. This is where we try to.
This is why I was a little happier today. We have some things going more positive.
Yeah, we tried to, again, give credit to City National Rockdale. They're one of the money managers that we work with. They do produce this on a monthly basis, and we like this because it's a quick visual look at what the projections are, and it's a 6 to 9 month projection. So we're kind of looking out through the balance of this year and into the first of next year. And there's still, there's only 2 green dials there on the table or the chart here. A lot of yellow, but again, as Dan pointed out, like the U.S. economic outlook, we've actually ticked a little bit higher.
Up.
It's positive.
Consumer sentiment,
Yes.
a little up. But this is the one I'm looking at: credit demand and availability. We talked about those small companies that need access to credit, and also people going to buy homes need access to credit.
Right.
It's there. It's available. And it's fairly cheap depending on the age. Jeff and I look at each other because we know we're probably in our forever homes because of the interest rates we have on our mortgages.
Sure.
But people coming in are getting reasonable mortgages, and we'll probably get more favorable mortgages if we get this rate cut coming up.
Yeah.
So this, I think, is a very positive outlook. And I was pleasantly surprised to see consumer sentiment to be tipping more positive than negative, and the outlook for the economy more positive. We've been in neutral the last 2 months that we've had this up.
Right.
And I think we're beginning to find a gear.
Well, yeah, the consumer spending is held up through everything over the last few months, and that's very positive. Our economy is such a significant part of our economy is driven by consumer consumption. Equity market valuations, we're close to the neutral area, but they're high. And historically, there's a lot of talk out there right now that maybe the historical numbers that we're using as reference to gauge the stock market valuations, maybe those are a little outdated. It's kind of a new conversation going. But currently, if you look historically, stocks are kind of at all-time high valuations.
Well, as you showed on the 52-week chart earlier, we're getting close to the highest valuations.
Yes, yeah, that's true. So, and then geopolitical risk, there's still quite a bit out there. As we record this, there's talk of some movement in the Middle East, some movement with the Ukraine-Russia area, but we've heard that before too. I think everybody now is kind of saying we need to see some positive results on all of that, but we'll see where that goes too. So, yeah. So again, just kind of continuing with that theme, that what's next. Dan and I were talking about this, and we thought it is very important to bring up some historical context here. August is historically or traditionally, whatever word you want to use, when you look back over any number of years of prior Augusts, it is almost always the worst year of the worst month of performance. Yes. August is a difficult month. You have a lot of people that are very active in the financial world. They're on vacation. So if you have a movement in the markets, it's probably on very low volume. Yeah, so there's not a little tweak here, a little tweak there can really move the market significantly. There's also a lot of uncertainty usually in the month of August. So, there are months, however, and that's why I wanted to put this chart on here, where it can be one of the better months when we look back over a prior 12-month period of time, but not very often. And so I think what we're trying, and we do have it for this year, we have the addition of the tariffs. As these tariffs, there's been talk since May that these tariffs were going to have significant impacts on prices and inflation in our economy. And we really have not seen that much yet. We haven't seen layoffs on the job front and in the labor market because companies are hanging on to their workforces. We're not necessarily growing at the rocket fuel pace that we had been in the past, but we're not seeing more workers getting laid off. But there's just a thought that that other shoe has to drop at some point and that it may be coming. And unfortunately, it may be coming in August or September.
And that shoe could be magnified, as Jeff just said, because volume could be low.
Right,
and what we mean by volume is volume trading, the amount of trading that's happening in the market. When news comes out, because there's low volume, it's a shallow pool.
Yeah,
it's a big splash. And you've got to temper some of that news sometimes. So it's kind of preparation for what might come this month.
Yeah.
We don't know, but
we don't know. And
just take it with a grain of salt.
Right. Well, and when you buy stocks, you're buying a company's earnings, okay? Mm-hmm. If they're having to eat some of the tariffs, if they're having difficulty passing on cost increases to their consumers, their earnings are going to go down. Now, we're already through the earnings quarter here. We're almost all the way through, and earnings were actually surprisingly very good.
It's the next slide.
Yeah.
Fact that you
so
it's
earnings were very good, but there is the chance that as we move into the next quarterly earnings report, as those start, we could see reflections of difficulty with corporate earnings there too, which obviously would have an impact. Now, one of the balancing acts there is the Federal Reserve meets. It's the middle of September. And there's strong thought that at this point, in fact, I think the market, they always place odds on this. Yeah, it's over 90% that there'll be at least a 25 basis point cut. Now, what that will signify is that the market's starting to the Federal Reserve is starting to enter a cycle where they are continuing their cut. They'd been paused for a period of time. That could have very positive impacts that would kind of offset some of these tariff increases and costs, that kind of thing. So it's all of a delicate balancing act. I think the bottom line, what we want to stress to everybody is expect some volatility in August, even into September, but let's start looking forward toward like the end of September into October, and then really that third quarter of this year, because most projections are for the financial markets to all be at higher levels by December 31st of this year than they are currently. Right. So we think there's just some short-term volatility with things setting up to be pretty good for October, November, and December of this year. So just a couple of things here. Markets recovered the losses, but economic uncertainty is still high. That's a fair statement at this point, but we're starting to get a little more clarity on several different fronts there. Probability of recession in the next 12 months.
It's always at 30%.
Yeah, I was going to say there's always a chance. It's really not normal. Yeah, it's not really. They're not. Nobody's really coming out and raising a lot of alarm bells because things overall look pretty good in our economy at this point. Mm-hmm. And that's about it. I mean, this chart was just kind of an idea of how things were going, and it does go back to about 2008, and we were coming out of a recession there. So and we had technically there's COVID
pandemic.
Yeah.
Yep.
So you can get an idea though. But so in other words, I think at this point, the idea would be to expect some volatility here over the next couple months, but hopefully we get some resolution to maybe some international conflicts. We get some resolution on the Federal Reserve, the interest rate front, and we can see some positive impacts on our portfolios.
Right. So with that said, we wish everybody a happy August, and we'll look forward to tuning in September remember, call the office. If you have any questions, we're here for you. And we look forward to speaking to you next month. Jeff?
Sounds good. Thank you
Excellent.
very much.
Take care,
Okay.
everybody.
Bye now.
Bye-bye.